Hey there, my name is Robert Reynolds, and in today's video, we're going to better understand the risks associated with debt. Most businesses require debt for operational reasons, and it's not necessarily a bad thing that a company holds debt, but too much debt can be terminal. There's a couple of different ratios that we could look at in order to better understand how terminal those risks are. In today's video, we're going to analyze the interest coverage ratio, and we're going to analyze the debt to equity ratio to better understand the leverage within a business. Does the company have the capacity to increase debt, maybe to finance growth, or are they over-leveraged? Is there a high risk of bankruptcy and default on that debt, meaning that the common shareholder essentially goes to zero? Let's get straight into it. Okay, our goal is to understand whether a company is overburdened by its debt. There's two different ways in which we're going to approach this. We're going to have a look at interest coverage, and then we're going to have a look at debt to equity. Interest coverage will give us an idea as to the interest expense and how much of that is sucking up our income, earnings per year. And then we're going to have a look at debt to equity. And what that debt to equity ratio is going to tell us is whether the company is over leveraged or maybe in certain circumstances it's under leveraged. And they can actually increase their debt level in order to capture growth into the future. So we're going to look at interest coverage and debt to equity to get an idea of the debt situation of a company. This should be used in tandem with liquidity ratios. Liquidity ratios are very important, and I'll explain why in just a moment. If you haven't checked out the update on balance sheet, towards the end of that we break down two liquidity ratios. The asset test ratio, and we break down the cash ratio. Both of those will be very important to understand the cash flow into the business. So let's get into this. We're going to calculate interest coverage. There's a lot of stuff in finance that is, I don't know whether it's purposely or by accident, but it's made out to sound very complicated. Most things are very, very simple, and it gives us a wealth of information to understand what's going on internally at a business. Interest coverage is very simply taking earnings before interest and tax and dividing it by your interest expense. So where do we get that? Earnings before interest and tax. This income statement is taken from Ticker Terminal. I use Ticker Terminal every day. We have a link in the description below. I think it's probably the best website for data that you could possibly find out there. And this format will give us what's known as EBT, earnings before tax. Now we want earnings before interest and tax, so we simply add back the interest expense and interest income. Don't forget the interest income. Where does the interest income come from? So if we have a look at our balance sheet, we have cash and cash equivalents. That breaks down into cash, short-term investments. A company might have a lot of cash in the near term, may not need it for the next 3 months, and they might invest in US T-bills for the next 3 months. Collect a small income, and that will be your interest income. The difference between both of those, we'd add it back to earnings before interest and tax, and then we divide it by interest expense. We divide it by our interest expense. Very simple stuff. You find your interest expense right here. That's the interest expense on the debt that we hold. Very simple calculation. Earnings before interest and tax divided by interest expense. What does this mean? Well, in this circumstance, we would end up with 5.097 billion divided by 421, which is our interest expense, and that equals 12.1 times. What does that mean? It means that the income of the business, the EBIT of the business, is essentially 12 times our interest expense. So we can afford to pay that interest 12 times throughout the year. So that's pretty good. And so when we break that down into understanding what's a good ratio, we can see that between 0 and 1 times it's terminal. The risk of bankruptcy is very high. Why? Because they don't have enough cash if it's below 1 just to service their interest expense using EBIT. Between 0 and 1 on interest expense is likely a bankrupt business. Between 1 and 3 we could consider as stable, but ideally you want something significantly above there. What that would mean is you have enough earnings just to finance your interest expense up to 3 times. It's not great, it's stable. Between 4 and 10 is okay, and then anything greater than 10 is great, it's excellent. The higher, the better. And in this circumstance, for this example, we have 12.1 times. So this here would fall into the great category, greater than 10. So interest expense, certainly from an interest coverage ratio perspective, is not a problem in this circumstance. So the debt, certainly financing that debt with the income, is not an issue. The second segment of this video, we're going to look at debt to equity. Now, debt to equity will be very easy to understand if you went over the video for the balance sheet. Essentially, the debt to equity ratio is taking the liabilities and we're dividing it by our shareholder equity. So how does a balance sheet balance? Well, on a balance sheet, we've got our assets, and that's equal to both liabilities and shareholder equity. We're taking the liabilities and dividing it by our shareholder equity, and that'll give us a ratio. So if the liabilities are less than 1, it means that we have more shareholder equity. This is great. It means that the business is under-levered. If it's between 1 and 2, it's still very good. The business is still very much under-levered, and there's still an opportunity to increase the leverage of the business. Anything over 2, we need to be a little bit more careful. We need to check the balance sheet for liquidity. Alright, so a couple of liquidity ratios that we went over in the balance sheet video go over asset test ratio, and as well as that it goes over the cash ratio. Both of those will give us more visibility as to whether this is good or bad. So we're going to look at an example right now, and we're going to use a company called Medifast. We're going to head on over to Ticker Terminal. Again, if you want to check out this site, there is a link in the description. We're going to key in our ticker. In this case, we're going to look at Medifast. We're going to go to Financials. We're going to have a look at the balance sheet. Remember, the balance sheet balances, we've got total assets, and then below here we have total liabilities, and then the total assets plus the equity, 326.35 million, should be equal to assets. That's how it balances. And what we want to do is pull up our calculator, and we want to take our liabilities, which is $175.83 million, and we want to divide that by our equity, 150.52. And that gives us 1.168. What that tells us is that this business, Medifast, is somewhat underlevered. They're not a leveraged business. They have the capacity to increase their debt load if they needed to finance growth into the future. So when we're looking at different companies, ideally what we want to see is, number 1, we want to see debt to equity ratio below 2, ideally. Anything below 1, it's very much underleveraged. And as well as that, when we're looking at the interest coverage ratio, we would want something closer to 10 and above than closer to 1. Anything closer to 1 is highly at risk of bankruptcy. So it's very important that we take both of those into consideration. If you're interested, we do cover the 3 financial statements here on the channel, as well as profitability metrics, such as the return on equity and the return on assets. Thank you very much for your support, and have a great day.